So, if you're an investor on the ASX, I'm willing to bet you've dreamed about building up that sweet, sweet passive income. I mean, that's the goal, right? But here's the thing. The most obvious way to find those amazing dividend stocks? It's often a minefield. Today, we're going to pull back the curtain on what I call the dividend deception. And this quote, wow, it just hits the nail on the head. A siren song. Think about that. It's this beautiful, irresistible call that lures you in, but it could be leading you straight towards the rocks. It promises safety and income, but there can be some really serious dangers hiding just beneath the surface. All right, so let's get right into it. Why do we chase these big yields? What's the big attraction? It's actually pretty simple. It feels like a sure thing, almost like getting a guaranteed paycheck from your stocks.
Okay, just to make sure we're all on the same page here, what is dividend yield? It's just the company's annual dividend divided by its current stock price. Super simple. So a $10 stock paying a 50-cent dividend, that's a 5% yield. And naturally, we think the higher that number, the better, right? Well, not so fast.
And you know what? It has never been easier to go hunting for these high yields. I mean, you can hop on a tool like the market index scanner, plug in a few numbers, show me companies over $1 billion with a yield over 5%, and boom, you get this perfect-looking list all ranked from highest to lowest. It feels like you've just cracked the code, right? Like you found the ultimate shortcut to easy money. But, and this is a huge but, there's a catch. Even the websites that give you these tools, like Market Index, they put up a big warning sign. That super high number, it could actually be a massive red flag. It might be screaming danger because the share price has been falling off a cliff, or maybe the company has stopped growing, or it could just be a one-off special payment that's never, ever going to happen again. The yield number itself tells you almost nothing about the why. And this right here, this leads us straight into the biggest, most common mistake that income investors make. It's called the dividend trap. So what is a dividend trap? Exactly. Well, simply put, it's when that juicy high yield isn't a sign of a healthy company, it's a symptom of a sick one. It's a warning that your capital might actually be at risk. Let's break it down. A dividend trap happens when a stock's yield looks incredible only because its share price has been hammered. Just think back to the math, right? Yield is dividend divided by price. If that bottom number, the price, goes down, the yield percentage automatically goes up. So you see that big number, you jump in thinking you found a bargain, and then wham! The struggling company cuts its dividend, the stock price tanks even more, and you're left holding the bag with a nasty capital loss. And I absolutely love this quote. Predictable income from a melting ice cube. It's such a perfect picture, isn't it? You're collecting the drips of water, that's your dividend income, feels good. But the ice cube itself, your actual investment, is getting smaller and smaller. You're getting cash in your pocket, sure, but your total wealth is literally melting away. That is the dividend trap. Okay, so if the dividend yield by itself can be a total smoke show, what should we be looking at instead? What are the metrics that really matter? Let's talk about what actually gives us the true picture of a company's health and what our returns could really be. And this is the key mindset shift we all need to make. On one hand, you've got dividend yield. It's just a snapshot. It only tells you about the cash paid out today. But on the other hand, you have the king, total return. This is the whole shebang. It combines the dividend income plus any growth or loss in the share price. This is what tells you if your ice cube is actually growing or if it's melting. Total return, that's the real driver of building long-term wealth. All right, the next critical tool in our toolkit is something called the dividend cover ratio. Seriously, think of this as your dividend safety check. It answers a really simple question. Is the company making enough profit to easily pay its dividend, or is it cutting it way too close for comfort? And what's awesome here is we get a nice, clear, actionable number to work with. The analysis from IG Australia suggests you should be looking for a dividend cover of at least 1.5 times. Think of it like a safety buffer. It means the company's profits could pay the dividend 1.5 times over. That's the kind of breathing room you want, just in case things get a little rocky. Okay, enough with the theory. Theory is great, but let's see how this stuff plays out in the real world. We're going to look at some actual ASX examples of potential traps versus companies that look a bit more sustainable. So first up, a potential trap that the Motley Fool pointed out, Woodside. You look at that 8.2% trailing yield and think, wow, that's incredible. But hold on,
Woodside's entire business lives and dies by the price of oil. And when oil prices fall, like they have been, so do their profits. And that puts that massive dividend payment in serious jeopardy. See, the yield looks great, but the risk is totally tied to something they can't control.
And here's another one to be wary of. Wham Capital. I mean, look at that yield, 9.45%. That is so tempting. But when you peel back the onion, you see that the reserves they use to pay those dividends are running low. And worse, the share price has been bleeding for years. This is a textbook melting ice cube. It really looks like they might be selling off parts of the business, shrinking their capital, just to keep sending out those big dividend checks. Now, this slide perfectly illustrates why focusing on dividend growth, not just a high static yield, is the real secret sauce for building wealth. Check out this comparison from the US. You've got AT&T, the classic high yielder. It did okay. But then you've got Lowe's, a company that was focused on growing its business and growing its dividend along with it. The result? More than double the total return. That's not just a little better, that's a whole different universe of wealth creation. So what does a healthier-looking dividend payer on the ASX look like? Well, here's a list from IG Australia with 5 examples. And the first thing you'll notice is that the yields are all over the place, right? From under 2% to over 6%. But that's not the important part. The magic is on the right. Every single one of them has a dividend cover ratio that's safely above that 1.5x line we talked about. Look at Evolution Mining. The yield is kind of low, but its profits cover that dividend almost 3 times over. Now that is a signal of sustainability. Okay, let's bring this all home. How can you take all this and actually use it to check up on your own portfolio? Let's go through a really simple framework for a dividend health check. And I want you to start with this one. Simple, but really powerful question. Ask yourself this about every income stock you own. If it stopped paying a dividend tomorrow, would you still want to own the company? Be honest. If the answer is no, well, that's a massive red flag that you might be owning it for all the wrong reasons. From there, you can run through this quick 4-point checklist. 1. Is the company actually making money? Does it have excess free cash flow? 2. Are its sales and profits actually going up? 3. Is the dividend payout reasonable? Check that cover ratio. And 4, and this one is so important, is the dividend itself growing year after year? Because a company that keeps raising its dividend is basically telling you it's confident about the future. That's a way better signal than a high yield that's just stuck in neutral. When you boil it all down, it comes back to this one core idea. Our goal as investors isn't just to collect a bit of income. It's to build real, lasting wealth. And the only true measure of that is total return. A good, healthy, growing dividend is an awesome part of that, but it's only one piece of the puzzle. So, I'm going to leave you with this final thought to chew on. That juicy high yield, it can feel really comforting in the short term, like a warm blanket. But if that comfort is coming at the expense of your actual capital, if your ice cube is melting, then you're trading long-term wealth for short-term security. And that is a trade that could seriously cost you down the road. Focus on quality, focus on total return, and you'll be building a portfolio that can actually support you for decades to come.